Welcome to Invest Like a Guru and to yet another book review in this series of book reviews that we have started doing here on the channel. Now, today's book is Your Complete Guide to Factor-Based Investing. And it is a very accessible book about a quite nerdy side, you might say, of equity investing. If you like numbers and statistics related to stocks, this book is definitely for you. It was written in 2016 by Andrew Birkin, an expert in structured investment management, and Larry Swedroe, a director of research at Buckingham Asset Management. The book takes an academic approach to what is called factor investing, which is a rule-based strategy that tries to provide higher returns by only investing in assets that have certain qualities. These so-called factors include measurements of things such as value or size or momentum, profitability, and so on. You might have heard about mutual funds and ETFs that go by features such as quality factor, momentum factor, or low volatility. These funds try to make better returns with a lower risk by utilizing one or more factors. Other factors include size, that's for example large cap versus small cap, or style, for example value of stocks versus growth stocks. With this book, you'll get a very good idea of how this factor thing works. I know it might sound a bit geeky and mathematical, but I'm sure you'll all get something out of it. The book is quite easy and understandable, especially if you have a serious interest in investing already. Now, for testing the factors, there are two ways of testing factors in stock markets. Either you go long only, meaning you test different factors by going long only, buying the stock, one category of stocks at a time. For example, you go long value stocks only, or momentum stocks, or quality stocks only. You simply identify what stocks have the highest score according to your definition of one or more factors. Another way of testing factors is by going long short, meaning you test the factor from both sides. For example, if you want to try out the value factor, you go long value stocks and short growth stocks. To test the momentum factor, you go long winning stocks and short losing stocks. This way you get a more exact idea of how valid the factor actually is. In the book by Birkin and Swedroe, various factors are studied from a long-short perspective. They put together different long-short portfolios and calculate the annual premiums by taking the return of the long portfolio and subtracting it with the return of the short portfolio. Let's say, for instance, that you go long 10 different value stocks and short 10 different growth stocks. During 1 year, the value stocks return about 8%, meaning the individual stock price have been rising. The growth stocks that we have been shorting return a negative of 2%. This is because the individual stock prices have actually risen by around 2% during that period, but as I am shorting the growth stocks, my return is negative. In this case, my premium has been 6%, 8 minus the 2%. Now about the market beta. This factor is an expression of how much an asset tends to move along with the broad market. This means that if you invest in every single stock available on the stock market, your beta would be exactly 1. A beta of more than 1 means that an asset has a higher risk than the overall market, and a beta of less than 1 means that an asset has a lower risk than the overall market. Let's find out if it really makes a difference to take on risk. Birkin and Swedroe tested this by simply calculating the annual average return of the total US stock market and subtracting the annual average return of the 1-month US Treasury bill. The first being the riskier asset and the second being the almost risk-free asset. This means you are going long the total US stock market and short the 1-month US Treasury bill at the same time. And the results? Well, from 1927 through to 2015, there has been a premium of 8.3% on average by taking on the risk of the overall US market. In conclusion, risk and return go hand in hand. A higher risk means a higher return, and therefore we have now shown that risk must be considered a factor in itself. Another factor that's worth considering is simply how the size of a company affects the return. If you could choose only one, would it be best to invest in small cap companies only or large cap? According to the study of Berking and Sweatrow, you should be investing in small cap companies only. By going long the smaller stocks and short the largest stocks during the entire period, you would have made a premium of 3.3% on average per year. This is when you subtract the performance of small caps with the performance of the large cap from 27 to 2015. To further prove that there is a size premium, Berking and Sweatrow researched on some passively managed funds and ETFs. They find that small cap funds and ETFs tend to outperform the general market. It should be noted that those funds and ETFs only provide data starting from the 1990s. However, there seems to be a size premium, meaning small cap outperform large cap over time. So this makes size a possible driver of your long-term return. Value factor. Well, one of the most well-known investment strategies must be value investing. Warren Buffett can be put into this category among many others. Value investing involves picking stocks that seems to be trading at a low price relative to their intrinsic value. The intrinsic value is often calculated by looking at financial ratios such as the price to earnings and price to book. For example, a low PE ratio is considered good. With regard to that, the opposite of value can be defined as growth. In general, growth companies are expected to have a higher earnings growth in the future. Growth investors are willing to pay higher prices for these stocks, meaning the PE ratios will be higher. Let's find out if investing in value stocks will make good results. Berking and Sweatrow divided the total US stock market into three categories: a value and a growth category, and then a middle category in between. The value stocks were defined as the 30% of the stocks with the highest book-to-market ratio. The growth stocks were defined as the 30% of the stocks with the lowest book-to-market ratio. By calculating the annual return of the value category and subtracting the annual return of the growth category, there seems to be a premium of 4.8% if you choose to invest in the selection of value companies only. Again, the test was done with data from 1927 through to 2015 with US stocks only. They went long the value stocks and short the growth stocks. We'll now turn our attention to the momentum factor. Momentum can be defined as the tendency for assets to have performed well in the recent past to continue to perform well in the future. And the same goes for assets that have performed poorly. Often they will continue to perform poorly according to the momentum theory. Berking and Sweatrow decided to test the momentum factor of US stocks from 1927 through to 2015. The test was done by ranking momentum stocks by their last 12 months of returns, excluding the most recent month. The most recent month was excluded to avoid any short-term movements that might occur. They put the 30% of momentum stocks with the highest relative performance to the overall market in one category, and the 30% of stocks with the lowest relative performance in another category. The premium of the momentum factor was 9.6% on average every year. The premium here is referred to as a return you would get by going long the stocks with the highest relative performance and going short the stocks with the lowest relative performance. You are simply buying the recent winners and short selling the recent losers. Simple as that. So, buying the best performance stocks over a 12-month period will most likely give you some good results. Almost 10% a year on average, at least according to the theoretical study. Finally, we'll shortly discuss two other factors, the profitability factor and the quality factor. Berking and Sweatrow also made a test on these factors. First, the profitability factor is simply defined by how profitable a company is, by going long in the most profitable companies and short the least profitable companies. From 1927 through to 2015, the premium was 3.1%. Well, this shows us that profitable companies tend to have a positive impact on our portfolios. And then we have the quality factor. The one is measuring a number of things related to the overall quality of the company. Quality stocks will have the following traits: low earnings volatility, high margins, high assets turnover, meaning efficient use of assets, and low operating leverage, and so on. The test was done according to these parameters by going long high quality stocks and short low quality stocks. From 1927 through to 2015, the premium was 3.8%. This shows us that quality companies provide higher return, at least historically. We have now seen some evidence of how different factors might affect the performance of our investment long term. Let's take a look at some results here. Now, in this table, we get an overview of how 6 different factors performed historically: market beta, size, value, momentum, profitability, and quality. This isn't the annual return on average. Next, you'll see the standard deviation of the factor portfolios. This is a measure of volatility or risk. The greater the standard deviation, the greater volatility of the portfolio. Lastly, you'll see the Sharpe ratio of the portfolio. Sharpe is a measurement of the return of an investment compared to its risk. In other words, the Sharpe shows how much risk you are taking relatively to the return you've got. A high Sharpe ratio is good. By taking on the risk of the average market with the market beta portfolio, the premium has been 8.3% on average per year. Your Sharpe would have been 0.40, but your volatility would have been quite high. By focusing on small companies with the size factor, the premium has been 3.3%. The Sharpe would be very low. Then by investing in value stocks in opposition to growth stocks, the premium was 4.8%. Still, the Sharpe was a bit lower than the average market. But the momentum factor portfolio had the best performance overall, a 9.6% return premium over the long time frame. The Sharpe ratio of the momentum factor was better than the overall market with a score of 0.61%. However, the volatility would also have gone a bit high compared to other portfolios. The profitability portfolio has been, as ironic as it may sound, the least profitable factor tested here. It only performed 3.1% in return on average per year. The quality factor portfolio wasn't the best either. Lastly, let's take a look at the final 3 rows, the P1, P2 and P3. This is when it really gets interesting, if you ask me. P1 is a portfolio allocated 25% to each of the 4 factors: market beta, size, value and momentum. P2 is a portfolio allocated 20% to each of those 4 factors, then also 20% to the profitability factor. P3 is allocated just as P2, but instead of the profitability factor, it utilizes the quality factor instead. As you can see, by combining the different factors, the volatility went down and the Sharpe ratio went up. The overall performance of P1, P2 and P3 did not quite match the performance of the market beta or the momentum portfolio. But if you want lower volatility, combining different factors seems to be a good idea. Especially the last one, the P3. It has the highest Sharpe ratio and provides a strong and steady return of 5.6% on average every year. Let's say you could tolerate the volatility, leveraging the whole portfolio 2 to 1. That would in theory give you a return of 11.2%. A double return with a double volatility, but still lower than the market beta and the momentum portfolio. The results from this book, they are very interesting to us, since here at Invest Like a Guru, we are very focused at momentum investing. And as these researchers have found out, it actually makes perfectly good sense to focus on the momentum investing. Now, our strategies in our subscription services and other models, they are a lot more complicated and refined as just to go along the 12-month momentum. So we are getting a better return with a lower volatility. But overall, looking at momentum, it suits perfectly well with our approach to the market. We hope you learned something from this video and got inspired to working with factors. We'll see you again soon. Bye for now.